Welcome back to the Wall Street Podcast. Today we're digging into the latest U.S. Economics Weekly. Summer break is over. It's a Citi research report just out August 29th, 2025. It gives a pretty sharp outlook on the Fed's path, inflation, growth drivers, and the labor market.
That's right. It pulls together the week's key data points to really solidify expectations around monetary policy. And it gives some, critical insights into the underlying economic dynamics.
And the main takeaway seems to be Citi's analysis is pointing towards a rate cut in September.
Yes, exactly. Driven by, well, a few converging factors. Softening inflation signals, somewhat uneven economic growth, and definitely a labor market that's gradually weakening.
Okay, let's unpack those areas, starting with the monetary policy outlook.
So Citi is holding firm on their expectation for the Fed to restart rate cuts in September. They're forecasting 5 straight cuts, 25 basis points each.
A quarter point each time.
Right, bringing the policy rate down to a range of 3 to 3.25%.
And market pricing seems to be reflecting that expectation.
It does. You see it particularly in falling 2-year Treasury yields. That signals investor confidence that, yes, a dovish shift is coming, easier policy ahead.
Got it. Okay, moving to inflation trends. What did the July data show?
Well, the core PCE inflation numbers came in pretty much as expected. It rose 0.27% month over month and 2.9% year over year. So
meeting expectations there. What about the supercore reading?
Yes, the supercore services, stripping out the volatile stuff, it did show a strong 0.39% increase month over month. But, and this is important, Citi attributes a good chunk of that to one-off portfolio management fees. They don't expect that particular boost to repeat.
Okay, so maybe not as hot as the headline number suggests. And what about the underlying trends?
Exactly. Beyond that specific factor, you see softer services demand overall. Plus, we got the Case-Shiller home price data for June, down 0.26% month over month. That's the 4th monthly decline in a row.
That's significant.
It is. It suggests a continued slowing in both services and shelter inflation, likely filtering through into next year. That's a key signal for the Fed.
Right. Okay, let's talk growth. Q2 GDP got revised.
Yes, and the revisions actually showed stronger underlying details than the initial print. Final private domestic demand was revised up to 1.9%.
But where did that strength come from? Was it broad-based?
Not really. It was quite concentrated in investment. Specifically, things like intellectual property products and business equipment. Citi notes this might be partly linked to AI-related spending.
Interesting. So targeted investment strength. But what about consumption?
That's the other side of the coin. Overall consumption, especially in services, is still slowing down. It rose just 0.1% month over month in July.
And that's the 4th month in a row of slow growth.
Correct. Plus, the advanced trade data for July showed imports surged. That can mechanically drag down the Q3 GDP growth figure.
Okay, so a definite divergence there. Investment holding up in specific areas, but consumption slowing. How does this tie into the labor market?
Well, consumer views on the labor market definitely worsened in August, according to the Conference Board survey. Their labor market differential, basically how easy people think it is to get a job versus how hard it fell sharply to 9.7.
And the jobs hard to get component specifically.
That piece increased significantly, and that component correlates quite closely with the unemployment rate historically.
So Citi's expecting the unemployment rate to tick up then?
Yes, they forecast it rising to 4.3% for the August report. And other indicators seem to back this up. You've got rising, continuing jobless claims, and also more businesses reporting poor sales in the NFIB survey. It all points towards a softening market and weaker hiring.
Okay, let's drill down a bit more. First on inflation. How exactly do these nuances like the supercore detail and the housing data really cement Citi's view on imminent rate cuts?
It's the combination, really. You have the July core PCE data, where the apparent strength in services seems transient, linked to those financial fees. You combine that with the persistent slowing we're seeing in actual real services consumption and the clear downward trend in home prices. Together, these paint a picture of decelerating underlying inflation. It gives the Fed pretty compelling evidence that their main inflation concerns are easing, paving the way for that September cut.
Right, it removes a key obstacle. Now, on the GDP revisions you mentioned, the strength was targeted, linked perhaps to AI. What does that specific type of strength tell us about broader economic momentum?
It tells us that the momentum isn't uniform. It's really stemming from focused investment in potentially high-growth areas like IP and business equipment, possibly fueled by AI excitement or necessity. This isn't broad-based economic acceleration across the board. It actually contrasts quite sharply with the slowing consumption trends and even contracting investment in structures.
So it's a bifurcated economy in a sense. Powerful niche drivers, but weaker general demand.
Precisely. It's not a sign of overall robust health, more like specific engines firing while others are sputtering.
Understood. And finally, the labor market.
Mm.
With all these indicators pointing softer, which signals should we watch most closely to gauge the trajectory? What comes next?
I'd say the consumer perception data is paramount right now. That jobs hard to get index is very telling as it reflects sentiment directly. And also the continuing jobless claims. Rising claims suggest people who lose jobs are finding it harder to get new ones quickly.
These are more forward-looking indicator.
Yes, they tend to lead the unemployment rate itself. They point towards that higher unemployment rate city projects, around 4.3%. It signals continued weakening on the demand side for labor, even if layoffs themselves remain relatively low for now.
So anticipates maybe easing wage pressures, continued hiring caution.
Exactly. Businesses are likely to remain cautious on adding headcount.
Okay, let's translate this. For you, the listener, what's the potential impact? A series of rate cuts starting soon.
That sounds positive for borrowing.
Yes, potentially. Lower borrowing costs could filter through to things like mortgages, car loans, personal loans. It might ease some financial pressure if you're looking at large purchases or managing existing debt.
True, but there's another side. The reasons for those cuts matter. Sustained slowing in services inflation, and maybe those falling home prices could help with daily living costs and housing affordability over time. However, the softening labor market introduces, an element of caution. Concerns about job security or slower wage growth might temper spending, even if borrowing gets cheaper. It requires a balanced view for personal finances.
So it really looks like an economy in a delicate rebalancing act. You've got this targeted, maybe tech-driven investment meeting a broader slowdown in demand.
That's a good summary. I think the key takeaway for everyone listening is to really watch how these different forces play out in the coming months. How easing inflation, this uneven growth picture, and the shifting labor market dynamics continue to influence not just Fed policy, but your own personal economic landscape.
Definitely food for thought. Consider how these nuanced signals might shape your long-term planning and investment decisions going forward.